Stop. Before you check your portfolio today, you need to watch this first. In the last 24 hours, the United States military launched strikes on Iran. The Dow Jones collapsed below 50,000. Oracle stock lost 10% overnight, and inflation just came in at 4.2%, double the Federal Reserve's target. This is not a normal market dip. What's happening right now could reshape your financial future for the next 5 years, and most Americans have no idea what's coming. In the next 20 minutes, I'm going to break down exactly what triggered this financial earthquake, and most importantly, the 5 moves that wealthy investors are quietly making right now to protect and even grow their money while everyone else panics. Stay until the end, because the last move I share, most financial channels won't touch it, but it could be the most important thing you hear all year. Let's get into it. Today, June 11th, 2026, will be remembered as a turning point. The United States military launched fresh airstrikes on Iran. President Trump accused Tehran of deliberately stalling peace negotiations, and within hours, the financial markets responded with chaos. The Dow Jones Industrial Average, the most watched index in the world, fell below 50,000 for the first time since May. The S&P 500 lost 1.62%. The Nasdaq, home to America's biggest tech companies, dropped nearly 2%. But here's what nobody is saying clearly. This is not just a bad day on Wall Street. This is the beginning of a cascade, and every American with savings, investments, or 401k needs to understand what comes next. Let me walk you through it, step by step. Every time the United States goes into military conflict in the Middle East, the first thing that happens is oil prices spike. Here's why that matters to you personally. The Middle East, particularly Iran, sits on some of the world's most critical oil shipping routes. The Strait of Hormuz alone handles about 20% of the world's oil supply. When military tension flares there, traders immediately price in the risk of supply disruption. Today, crude oil prices surged immediately after the strikes were announced. Now, what does expensive oil mean for Americans? Number 1, gas prices go up. The average American spends over $2,000 a year on gas. A 20% spike in oil could add $400 to your fuel costs just like that. Number 2, everything gets more expensive. Oil is an input cost for almost every product, from food packaging to shipping to manufacturing. When oil goes up, inflation follows. And inflation, right now, is already at 4.2%, more than double the Fed's 2% target. So ask yourself, can you afford for inflation to go even higher? This is why what's happening in Iran is not just a foreign policy issue. It's a personal finance emergency for millions of Americans. But it gets more complicated. Stay with me. The Dow falling below 50,000 sounds like just a number, but let me put it in perspective. The Dow Jones is made up of 30 of America's most powerful companies: Apple, Goldman Sachs, Boeing, JP Morgan. When it falls, it means America's corporate engine is losing confidence. Now, here's what the mainstream media won't tell you clearly. The Dow didn't just fall because of Iran, it fell because of 3 things happening simultaneously. Strike 1, the Iran military conflict injecting fear into global markets. Strike 2, inflation data coming in at 4.2%, hotter than the economy can handle. Strike 3, the Federal Reserve, now under new chairman Kevin Warsh, expected to raise interest rates, not cut them, at the June meeting. When interest rates go up, borrowing becomes expensive. Companies earn less, stock valuations compress, and retirement accounts, millions of American 401ks, shrink. This is the triple threat, and all 3 are happening right now at the same time. So what do you do? We'll get there, but first, I need to tell you about something that shocked even the most experienced investors today. Oracle, one of the most powerful technology companies in the world. Last night, they announced plans to raise $20 billion through equity and debt to fund AI infrastructure expansion. The stock immediately crashed more than 10% in after-hours trading. Now, why does an AI investment announcement cause a stock to crash? Because raising $20 billion means diluting existing shareholders. When a company issues more stock, every share you already own becomes worth less. But there's a deeper story here. Oracle's announcement is the latest signal that the AI arms race is becoming dangerously expensive. Microsoft, Google, Amazon, Meta, they're all spending hundreds of billions on AI infrastructure. The question investors are now asking is, when does this spending turn into actual profit? At the same time, Super Microcomputer, another major AI player, plunged 28% after its own financing announcement. Two major AI stocks, one day, both crashing. This is either the beginning of an AI bubble correction or a temporary panic before the next leg up. Which one is it? I'll give you my analysis, but first, let's talk about the most important number of the day. 4.2%. That is the current annual inflation rate in the United States as of May 2026. To put that in plain English, if you had $100 last year, it now buys you $95.80 worth of goods. And it gets worse. The Federal Reserve, America's central bank, has a target of 2% inflation. We are more than double that. New Fed Chairman Kevin Warsh is expected to formally announce at the June meeting that the Fed is abandoning its interest rate cutting plans and may actually begin raising rates again. Here's what that means for you. Your mortgage gets more expensive, credit card rates go higher, car loans cost more, and the housing market, already strained, could cool even further. But here's the twist that most people miss. High inflation combined with high interest rates, combined with a war-driven oil spike. This is a very specific type of economic environment. Economists call it stagflation. Stagflation is rare. The last time America experienced it was in the 1970s, and it punished regular investors who did nothing. But, and this is critical, certain assets don't just survive stagflation, they thrive in it. I'm about to tell you exactly what those assets are. This is the part you've been waiting for.
Alright, you now understand what's happening and why. Let's talk about what to actually do. Here are the 5 moves that historically perform best in exactly this type of environment: war, high inflation, rising rates, market uncertainty. Move 1. Gold and commodities. Gold is the original safe haven. Every time military conflict escalates, investors run to gold. It holds its value when currencies weaken and inflation rises. Historically, during Middle East conflicts, gold has rallied 15 to 30% within 6 months. You don't need to buy physical gold. You can invest through ETFs like GLD or IAU, available on any US brokerage. Move 2. Energy stocks. When oil prices spike, energy companies make more money. Simple as that. Companies like ExxonMobil, Chevron, and ConocoPhillips have historically outperformed during oil price surges. If oil goes to $100 a barrel, which some analysts now forecast, energy stocks could deliver 20 to 40% returns over the next 12 months. Move 3. Short-term US Treasury bills. When you're not sure what's going to happen, cash-like instruments protect you. Right now, 6-month Treasury bills are paying around 5 to 5.5% yield. That's a guaranteed return backed by the US government while you wait for the dust to settle. In an environment of falling stocks and rising uncertainty, 5.5% guaranteed beats losing 10% in equities. Move 4. Dividend stocks in defensive sectors. Healthcare, utilities, and consumer staples. People need these regardless of war or recession. Companies like Johnson & Johnson, Duke Energy, and Procter & Gamble have paid consistent dividends for decades. They tend to fall less than the market in crashes and pay you while you wait. Move 5. The contrarian play. Quality AI stocks on sale. Here's the move most channels won't say. Oracle fell 10% today. Supermicro fell 28%. Nvidia and other AI chips are under pressure. But ask yourself, is the world going to use less artificial intelligence in 5 years? Of course not. This sell-off, driven by fear and uncertainty, is creating a potential buying opportunity in the highest growth sector of the next decade. Warren Buffett's most famous quote, "Be greedy when others are fearful." The question is, do you have the courage to act when everyone else is panicking? That's the move that separates wealth builders from wealth destroyers.
Let me leave you with this. The events of June 11th, 2026 are a reminder that markets don't care about your comfort zone. They move fast, they punish the uninformed, and they reward those who prepare. Right now, millions of Americans are watching their portfolios bleed and doing nothing. They're waiting for someone to tell them it's going to be okay. But the people building real wealth, they're watching the same news and seeing opportunity. You now know more than 90% of Americans about what's actually happening to the economy today. Use that knowledge. If this video helped you understand what's going on, hit that like button. It takes 2 seconds and helps more Americans find this information. Subscribe to Wealth Buy because this situation is evolving daily and we're going to keep tracking it for you. And drop a comment below. Which of the 5 moves are you considering? I read every single one. Until next time, follow the money. Predict tomorrow. This is Wealth Buy.